to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio, and Jerry First is joining us today. Before we get started, we have our disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical accumulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. With that, this disclaimer is also at the bottom of all of our web pages if you want to read it in full detail. And Jim, would you like to ball first, or you want to give it to Jerry first?
Nope, why don't you give it to me first?
Nope.
Okay.
You've got it.
Okay, share. Let me get the right screen here. Okay. Okay. Before we start getting into some of the technicals and what's going on in the markets, Jerry and I were speaking, as I was speaking with a lot of the institutional guys that I deal with, and we're in a situation where everything else might not matter except for QE. You know, with QE going on in Europe now, the issues that were going on in Greece, Tom's mortgage getting cheaper and cheaper. For those of you that don't know the inside joke, Tom lives in Germany, but yet does his revenue and most of the expenses and his revenue is in U.S. dollars. So the cheaper the euro gets, or the stronger the dollar gets, the cheaper his German mortgage gets for him. So Tom, you've been very happy recently, and yet again over the weekend with the euro coming down. What are we down to? 112 now. It's been.
Correct.
Tom, I'm sorry, you were breaking up. Say it again.
Is that any better?
This is much better.
Okay. Yeah, well, it's 113.29, so yeah, pretty close.
Okay. And so what ends up happening is that with the massive amount of liquidity that's being pumped into the markets, not only in Japan, which we had spoken about previously, but now also throughout Europe, what goes on with Greece, you know, more money might flow into the market, less money. So those decisions that are made by reserve banks, Federal Reserve-like banks around the world are going to end up really having a huge impact on everything. So when that ends up happening, you can end up realizing focus on that news because that will end up having a major, major effect. Having said that, what I wanted to end up doing is just going over some technical analysis, some chart patterns, where we are in things, and I thought who better to end up having on with me than Jerry First. What I'm going to end up doing is I'm going to end up showing you a little bit of what I've done, and then Jerry will end up going into a little bit more detail. You know, this is you know, Jerry's specialty. You know, options traders, we do a lot of different things. While Jerry will end up trading a little bit of options and a little bit of other things, you know, where he has his subject matter expertise from my perspective, what I've seen him do for a very long time was exactly this. He'll end up seeing chart patterns sometimes that, you know, he has to point out to me, which he does on a regular basis. What I am liking to do, and Jerry, I know, does this on multiple time frames. I always like to step back and see where we are and make sure that I have the trend lines, you know, they're still relevant. What I try to do is I try to keep my charts relatively clean. I'm using Thinkorswim because I've been using this a long, long time, and it has a lot of the indicators that I like to end up using. I know that Jerry will end up showing you the paid version of freecharts.com. I don't know if Jerry's on, if you could hear that.
Yeah, I just unmuted myself. Can you hear me okay?
Yes, yes. You use the paid version of freecharts.com?
Right, TC2000.
Right.
But I use a lot of different charts, so that's
Okay.
only one of them. Yeah.
Okay, we'll get there in a second. So what I ended up doing is that I wanted to end up showing, some of the lines that I had drawn years ago and are still relevant today. The first one was, my starting point was the bottom in March in 2008. We started to end up running up. And what was resistance originally after the initial run-up and come down ended up being, what was support initially ended up being resistance for the next several years. So a very, very strong trend line. One of the things that is important is that the longer a trend line has existed, the stronger it ends up getting. Okay. What I ended up also doing is that I drew another support line when we ended up coming off of our highs in 2011, and after the Federal Reserve, after the U.S. Congress didn't pass the debt ceiling in a timely manner, and we ended up getting downgraded by the credit agencies, we being the U.S. government debt. I ended up drawing a support line, which ended up being, good for the next year and a half. I don't take that support line away because it will come into play at some point in the future. And it will probably end up being, a pretty important support line at one point. I ended up drawing another support line, okay, from late 2012 onward, okay, and so now let's start to make the graph a little bigger. And you can see that the support line was broken a few times, and when we finally broke it, it did end up being resistance here and over here. So if I come and take a look at what's gone on recently, these are the multi-year trend lines that, it doesn't surprise me that we've started to end up running into some resistance up here. I drew some price level supports, okay, somewhere around $1,900, also around, I don't know if I can end up seeing that. Maybe if I end up making it a touch smaller, it'd be easier to see. All around 1990 or so, we ended up having 2000. We got through. I could have run other ones around 2015, but I decided not to end up keeping it to keep my charts relatively clean. I drew a Fibonacci from the lows in October that we ended up having to the highs that we had right before the new year. And so if I just highlight the Fibonacci's, you can end up seeing everything to the right of my cursor right here at around the beginning or the end of last year. It's fair game for the Fibonacci's. You can end up seeing that a 78.6 didn't hold at all. But boy, the 61.8 did. Plus also it's near that support line in between 1990 and 1985. You can see that we've come down after this and we've touched it 3 times. So we have this sideways pattern that if we continue to move sideways, we'll end up being into some type of a resistance on the top and a rising support trend line. So as we move forward, there's a fair, probability that we're going to end up having wider ranges, but once we end up breaking out of this sideways zone, we could end up moving significantly in one direction or another. Couple of quick points with this. The first one is, and we've gone through this a couple of times, but for those of you that haven't seen this, let me end up showing you the capital discussions, okay, page that, Jerry, have you seen the tool that Tom has built for the price analysis?
I'm sorry, say again.
Have you seen the tool that Tom has built for price analysis?
I saw 2 or 3 of them. Yeah. Oh, wow. He's added quite a few of them. Okay. I have not seen all of these.
No, and a lot of members haven't. Tom is always trying to. We talk about what tools would be useful, and Tom's trying to end up getting as many things, okay, for our traders as possible. This is one that I really, really like. I mean, the earnings one is great, and that was the first one. But there's this price movement analysis. So if I could take a look at the S&P, it defaults to the S&P. And what I'm going to do is I'm just going to take a look and see, well, what's happened from January 1 of last year until now. I'm going to end up taking a look at each of the, I want to look at the data, and then I also want them to adjust for dividends. So you can see here, it always starts from the most recent and then goes backwards. And here's the daily range. Okay, so this is actually the data that's used, okay, when you're calculating your ATRs. So when I take a look at my range here, okay, we're having the maximum move, the average, and the standard deviation. If you take a look at that average, 17.7 is the average, and 9.6 as the standard deviation. Right? Remember those numbers just for a second, because if I come back up here and I end up saying, well, how have we done, let's say from, let's eliminate that that really nasty pullback in October, and let's just look from December 1st. So now I'm looking from December 1st to current, right? It defaults to current. I hit refresh. Now look at this. The average has gone from 17.7 up to 25.7, and the standard deviation went from 9.6 to 11.5. And this is including the break, okay, when everybody in the world's on holiday from, Christmas to New Year's. If you take a look at how low this data is in here, that's included, okay, with a much higher weighting, obviously, because there are many fewer days. When we take a look at what's recently happened, one of the things that most professional traders will tell you is that when your daily ranges start to end up getting much larger, okay, you're setting up for a big move in one direction or the other. So we got three things here that tell me I need to be concerned. First and foremost, we have liquidity events going on around the world, and whether you want to call that fundamentals or whatever, in terms of all of the intervention by central banks. You have the issue, okay, with Greece possibly, negotiating with the EU about how much more support they'll get. Tensions are running pretty high. Then you take a look at the fact that we have been having our daily ranges get much larger, okay, in recent times. And then you have this sideways movement, okay, between support levels and the resistance levels with an increasing trend line that it's almost like a pressure cooker, I think. And when we do break out of this in either one direction or another, after we've had these larger moves and this sideways, rather wide range from, let's just call it roughly, 1980 up to 2020. I'm sorry, 2093. I look at this and, Jerry, I'm concerned. When you look at the technicals, what do you see in the S&P 500?
Okay, so when I'm looking at the S&P or any of the indexes, I'm always looking from a high time frame down to a low time frame, and the Federal Reserve has been very good for the last 6-7 years of just pumping as much as they can into the market. So over the long run, it's just grinding higher. At the right edge of the chart, we're going sideways, and on the short term, it looks like from a macro and from a short-term perspective, technically, it looks like it wants to do a pullback. And one of these days, a pullback's going to turn into a real correction. So that's where I look at, that's what I'm seeing right this minute. Back to you, Jim. Hello? Hello?
Tom, I'm sorry, I had myself on mute. I was just talking to you. Tom, do you want to give Jerry the ball? Jerry, do you want to end up showing us the chart patterns? And I just have, this on a daily pattern, so I haven't ended up taking a look at the depth that you take a look at technicals on. But do you want to end up sharing some screenshots and some of the studies that you've looked at and give us an idea of, where you see, things going?
One of the screens that I'm watching on one of my monitors every day tell me If you can
Hey, Jerry, it sounds like you're not talking towards the microphone.
see. I actually had it on mute this time. Okay, how's that?
Oh, much better.
Okay. So does everybody see 3x3 nine charts?
Yep.
Okay, this goes way back to my currency days, and this is how I watch the global markets. And so everything is interconnected. And so I'm watching on the top line, I've got the euro, the pound, and the yen against the dollar. I got the dollar index. Front and center, I've got oil. And you can just see how, talk about chart patterns, the triangles and the complete breakdown, and now a little bit of a rebound in oil. Then you've got gold, which I think deserves some discussion. I'm not sure how much tonight, but you got to look at gold for a lot of reasons. And then on the bottom, I've got the S&P, the Dow, and the NASDAQ. I don't have they don't provide the Russell on these charts, which are no charge. So this is the screen that you are showing. This is a weekly chart. And this actually is from a blog post that I did back on November 8th. November 8th of 2014, I went ahead and posted that we've got this candlestick pattern called a hammer. And a hammer, the definition of a hammer, just real quick, kind of just for argument's sake, a hammer technically has a small body with a little bit of what I call the wick. Some people call it a shadow. A little bit of a wick on top and then a long wick on the bottom. However, if this was in the middle of a range, that wouldn't qualify as a hammer. A hammer has to show up at the bottom of a range, and then you go ahead and start making higher highs, or I should say higher lows. And so on this weekly chart, I'm always looking for what I consider to be fractal patterns. And so notice here on November 8th, I said, are we here? Whereas at this point on November 8th, are we at the center point of this consolidation phase where this run up is equal to this run up? So the definition of fractal patterns is that it's a smaller or larger representation of another similar pattern. So having said that, let's take a look at what's happened. Oh, and also, yeah, just from what I was saying back then was that I was looking for a possible triple top to form on the S&P 500 with maximum resistance of about 2064 to 2093 within the next 3 months between November and February, so we're right there, to be followed by a decent 20 to 35% correction between now and then, with lots of impulsive upside moves, but that's just my opinion. I could be wrong, and that's my disclaimer. So if we go back to that chart, it's right here, same exact chart. You can see that we've gone ahead. We were over here. I was expecting kind of like a triple top. And notice the high that we hit on the weekly doubled was what, 2091 roughly? The actual high, 2092.4. And then we came back down to this consolidation over here. That was my 2063 right here for a couple of weeks. And notice how the 2064, 2063 range, that's holding support and resistance. But now we keep testing those highs. These wicks that we have up here, up on top, price is testing but it's not staying and holding and making higher highs. So, and we are making lower lows. Now, that's on the weekly chart. Now notice, here's my hammers. You can see at the end of a down run, beautiful hammer down here, hammer down here, hammer down here. So I'm looking at the patterns as far as the S&P. We're sideways on the weekly, on the daily. This is pretty much what you were showing on the Thinkorswim charts. But what I see here is interesting. I tie together a lot of things. I tie not just the charts, I also look into the technicals, but pattern-wise, we have what I consider to be a W pattern right here. Now, this is an interesting W pattern because if you remember going back to grade school, a W could be done like this, or a W could be like that, which is what we have here. I prefer to see a W pattern that looks like this because once you cross the center point, I have a price target to make a double top. In this case, we've made triple tops. And so once again, we are battling right now between, let me clear the screen for a second. We've got obvious, this is, I believe, where, Jim, you drew your, well, I could do it with this. Hold on a second. We've got a good support resistance line here, which is, I think, where you had yours drawn.
Very close.
And we have this, yeah, and we have this trend channel, as Jim was saying earlier. The number of times that you hit that support line, the stronger it is, especially if you're on a high time frame. So now we're on a daily chart, and you can see that we've got numerous hits. We've got, we'll call that a hit, all of these spots right here. Extremely strong support. So I do see, whenever you're in the middle of a range, it can always go up or down. When we were at the top of this trend channel, notice how many times we had hit the top of this trend channel. When I'm seeing at the top of a trend channel like this, that's where I'm more willing to go ahead and bet to the downside, because that line is just so strong. And so I might sell some calls up here just a little bit higher. I might buy some inexpensive, if I'm not really sure, I might buy some inexpensive puts all the way down, towards the bottom of the trend channel. Depends on how I feel. Now, that's looking at the S&P. That's on the daily, weekly chart. I want to flip over and just show you my macro, what I'm looking at from the macro for a second, then I'll get back to Jim for a second. This is from a macro perspective. This is what has my attention right now. I love the, a picture tells a thousand stories. And Angela Merkel was over in Russia, I believe, over the weekend, and she didn't look happy. I didn't have a chance. I was on a call with a client. I did coaching and mentoring, and I wasn't able to tune into the press conference, but I want to go back and find it on YouTube or something. She didn't look very happy at all. And the problem that we've got on the global picture is if Greece goes ahead and they said, look, we're broke, and we're not going to go ahead and whore out our, sons and daughters anymore. So, and it looks like Cyprus has gone ahead and just given military ports to Russia. and they've rerouted their gas and pipelines through Turkey, which is supposed to be another friend of the U.S., kind of. And so the whole European Union Russian situation with Greece is weighing heavily on my opinion of the charts. One of the sayings that I have is that I'm 80% technical but 20% fundamental in my making trading assumptions, trading decisions, but I'm 20% fundamental exponentially weighted, saying that at the right edge of the chart, when you've got these huge explosions that kind of look like tactical nukes being put out. I don't know if anybody saw that this morning. They tried to say that it was a I think, Tom, you've been in the military. I don't know if you saw a video of this explosion over there and somewhere up in Russia, Ukraine.
Oh, yeah, I did see that. Pretty impressive.
They said it was an arms depot, but usually an arms depot would be like multiple. That was just one big blast.
I thought it was like an oil refinery or something.
Yeah, could have been. But basically, what are we talking about? Fear. We have fear. So what happens when the market detects fear? Usually volatility goes up. Now, could all that money from Europe be coming into the U.S. stock market? Absolutely. So as much fear as there is, it could be bullish. That's one argument. But I would just say that overall, I would expect that the option premiums should be getting more expensive. So that's my take in general. I do watch the Dow, and I watch the Dow components because it's interesting, as well as the financials. But, you know, usually when there's a full-blown market trashing, everything goes down. Money is being obliterated. And
Jerry, just to end up adding to one of the points that you just made, a lot of times I'll watch the difference between the VIX and the volatility on the VIX. So like they're one derivative apart, right? The VIX is basically the implied volatility of the S&P 500, which is known as the VIX. The options on the VIX, or the VIX, is the volatility on the options on the VIX. And what ended up happening in October and also in December is that the VIX started to end up moving higher at a much more rapid rate than did the options on the SPX. There's been a lot of separation, between the two. I think a lot of it may have to end up doing with all of the volatility or VIX-based ETFs that they're out these days. But we are stepping up again. And a lot of people might take a look at the VIX and say, well, it didn't really end up rising that much, right now. And while that's true, the two things that have happened is, one, the VVIX has moved up at a more rapid rate, and two, the skew, the cost of the out-of-the-money stuff has gotten more expensive than the stuff at the money. People aren't so worried about small moves right now. They're worried about big moves. And so I'm just kind of summarizing that everything you just said is being mirrored in the price of the volatility of the options on the market.
Exactly right. So you summarized what I did in 15 minutes and 3. So to me, when we're trading and investing with options, the 3 unknown components are price, time, and volatility. And to me, volatility is my friend. Some people like slow, steady grinds up, and you know, and they're not used to those volatile moves because they don't come that often. But when they do come, there's a lot of opportunity in there for some, and for others, a little bit more risk. The other thing I think you alluded to, the VIX product originally designed for the S&P 500 Now that we have weekly options and VIX on VIX on VIX derivatives, the true meaning of the VIX has been diluted because if you are an institution, you can take on a VIX position in a weekly option for a couple of days. In the past, you were locked into the quarterlies and the monthlies. So that's a big market dynamic that's changed. And so I love first level derivatives, but once you get into derivatives of derivatives, I kind of step back. I'll let other people do that. But yeah.
Okay. We've been going just about an hour. So if we kind of wrap things up, what do you see going? I'm sorry.
Half an hour.
We're going to half an hour. Half an hour. I'm sorry. I didn't realize. I'm sorry. I thought I saw 32 after the hours. But I still want to ask the same question. So when you take a look at this, and you can never predict about the future, but what are the areas that you think are the probable moves, okay, going forward in the major indexes? You know, what are you worried about? What are you trying to protect against? What are you trying to take advantage of where we currently are now?
Okay, yeah, good question. I think the last time I was on, because I don't trade the big contract, I trade the ETF, IWM for the Russell, and I was on a couple of weeks ago. I don't know if you remember, was it the 15th of January? If you want to look back in the archives, you can see at the very end, it was like only for 5 minutes, I carved up the chart, and I was saying that we have overhead resistance up about here, and support down here, but back then I think that was the week of the 15th. Was it January 15th?
January. Yeah, so it was about a month ago.
Yeah. So here's the week of January. Oh, these are dailies. Okay. So here we were, January 15th. So we were smack in the middle, and I was saying that, you know, we've got our support and resistance areas here. Now it's up to you as an individual to go ahead and decide, are you bullish, bearish, neutral? Do you want to, you know, do you want to buy some puts down here? Do you want to sell some puts down here? On the flip side, do you want to buy or sell some calls up here? Do you want to go ahead and do a strangle or a straddle? Because we were smack in the middle. And sure enough, we went ahead, we came down, we came almost right down and almost tapped that line right there. And we just, look at that, right down to the tick. I haven't changed this chart because I don't trade the Russell on the big contract. I use IWM. But it looks like we hit that pretty close right there. And so it's the same thing as what pretty much where we're at today, except that we're at a higher level. From a candlestick perspective, notice the hammer pattern right here. Doesn't have to have that little nub of a wick on top, but it's still at the end of a down run, long wick. Big bars up, spinning top over here, and then a gapping, not quite a gap down on the open today. And this is pretty much, from a candlestick perspective, these are kind of pointing to the way down. We got our 50-period moving average up here at 1180. Is that the 11/5? Where are we at here? 1180. So that's the 50-period moving average right here at 1184. I'd say there's a good target on the Russell to come down and tap the 50. Could happen tomorrow. Could take us a couple of days. What happens after that? I'd say that we're still stuck in this range. We do have a little bit of a gravitation to make higher lows, and so, you know, it's up to every individual to make their...
And we've also made lower highs too.
Yeah.
You know, so we actually do have a little bit of a pennant, right? If you take a look at the the lower highs and the lower highs and the higher lows, we do have a kind of a wedge or pennant starting to form here.
Well, kind of like a pennant, but the issue with the true pennant, let me go ahead and draw a little bit. Okay, so a true pennant would be coming up and then making a pennant, like a baseball pennant like that. And that pennant really does have to come kind of like with a flagpole to a degree. It doesn't have to, but it's a stronger pattern. A wedge pattern, in fact, man, I've got some great examples on some PowerPoints. If I go ahead and pull up, if I pull up the DIA, and notice this is a TC2000, I can go ahead and drag backwards and bring more time in. Good pennant would have been something like this. I'm sorry, a wedge. You see this right here? Oh, come on. They put these little buttons down here that screw me up every time. Let's try a weekly. Okay. So what I'm trying to do is just get that to the right edge. Okay, there we go. So I kind of describe a wedge. Think of it as like a small slice of pizza that's either pointing up or that's pointing down. And so this, I think, is a good example of a wedge and very powerful pattern, because what you'll see is that once it broke out of it, typically people are expecting that to break to the downside, believe it or not. You would think we're making higher highs and higher lows. You'd think that we're going up. Most of the time, it's actually a bearish pattern. And notice it did break to the downside there, but then it broke right up. And when it went through that resistance of that trend line right here, then that was QE. That was just more money into the market, and it just continued to grind higher. Notice how the moving average right here was it just seems to respect. There's my hammer right there, tapping that moving average.
You respect that moving average, huh?
Yeah. See that? Look at that. There's another hammer right there. Very powerful. When I teach candlesticks, I point out about 6 different major candlestick patterns. There's a whole bunch of them. You can read up all the books, and I've attended a 4-day workshop out in Texas years ago with Steve Bigelow, and a 3-day workshop with Steve Neeson in Orlando years ago, and so I've paid my admission fee for sitting there watching these patterns over and over again. And then, like everybody else, I've kind of come and made it my own. The last time I saw Steve Neeson in person, I was asking him about the tweezer patterns, and he didn't give it much thought. He really didn't. He thought it was just another pattern he doesn't really look for, where I like tweezer patterns a lot when they do show up.
What's a tweezer pattern?
Tweezer pattern, let me see if I can find one. At the top or bottom of a range, and that's another thing. It has to be, candlesticks are all about reversal patterns. It's not, if you have something in the middle of a range, candlestick patterns may be showing some strength or weakness, but candlesticks are all about reversals. Let me pull up, give me a stock, any stock.
Volatile or non-volatile?
Yeah, well, see Apple. I got to try and see if I find one here real quick. How about, here's a classic one. Gold on a monthly chart. Here's a classic tweezer pattern right here. Okay, we have a long run to the upside.
Mm-hmm.
Then we have a large up bar that made a high that it couldn't hold right there. And then we have the next bar next to it also had a high that it couldn't hold. Notice that the opening on both days were about the same, and then it was followed by a large bar down. And so that right there, that's a picture perfect tweet. Notice it looks like a pair of tweezers, right?
Okay, got it.
And
yeah,
so
I didn't know that's what it was called. That's a very important pattern. I paid a lot of money to learn that pattern during the .com. Okay, if you take a look at what happened in 2000, January, February, March, we tried to make new highs and we couldn't hold them, and that's exactly what it looked like. Two very, very large body candles that just sold off.
Exactly.
Joe DiNapoli calls those railroad tracks.
Railroad tracks. That's interesting. My trend lines here.
No, tweezer.
No. Your tweezer patterns, your chopsticks.
Oh, okay. Because actually, yeah, there's another guy, Oliver Velez. He has railroad tracks. He calls railroad tracks when you have parallel moving averages, when you have a beautiful uptrend, like if I was to add...
Oh, yeah, I've seen that. When you have like a 20-day and a 50-day, and they're just moving perfectly parallel.
Mm-hmm. Exactly.
Yeah.
If I was to add another moving average... And let's go ahead and put it on the price. And let's change that over to... I like anything between 20 and 22 I like. And so you've kind of got, this is where I see like railroad tracks with those parallel lines like that. That's just a beautiful uptrend. But yeah, okay, railroad tracks from a candlestick perspective is interesting. Now the interesting thing, and I'm a stickler for being precise, there are, when you're talking about candlestick patterns, it's kind of like I'm an English teacher, like you should have had a comma, not a period there. And so there's very definite candlestick patterns such as morning star, evening star, bearish Haramis and things like that. And some people, they just go ahead and make up their own names. But who did you say it was? Presavano, or who gave that the railroad name?
Oh, that was Joe DiNapoli.
DiNapoli, yeah. Okay. And I've got the utmost respect for some of these people who are living legends with the computer generation, being able to create some of these indicators, DiNapoli indicators. But if I saw him to his face, I'd challenge him on it. I've gone ahead and I talked to John Bollinger, and I said, John, it's like people have these Bollinger Bands, but I mean, price can consistently rise, above the top end or the bottom end forever. And he said, I agree with you. Most people don't know what the hell they're doing. They should buy my book because I explained to them, how to use the Bollinger Bands properly. Just because something is at the top edge or the bottom edge of a Bollinger Band, that's not the only thing to look at. So anyway. And I also had some discussions with John. I used to be a speaker at the Intershow World Trade traders expos and stuff. So I used to be able to get into discussions with some of these people with a couple of drinks. Anyway, I digress. So gold, as long as we're looking at gold, great example of a tweezer pattern. Also notice all my Fibonacci's and my targets here. Gold is heavily manipulated, but I believe gold is the one true currency despite arguments to the contrary, and everybody's entitled to their opinion. But I think that when people are running for the borders, you can put a lot of money around your neck and on your wrist and to your pockets. I guess you could even swallow it if you want. When times get tough, gold gets strong. The problem is with this GLD, it's only paper, and you can't convert it to gold. So that's why you see the disconnect. Try to actually get real physical gold in any size quantity, and you better make sure you have a spectrometer. Make sure there's not too much lead or tungsten in there. So anyway, so I'm looking at gold. I'm looking at the indexes. I've recently put on a calendar spread on the Russell using the IWM. And on the IWM, you can see here on the weekly chart, I'm looking for potentially a target of 114 on the ETF. And I've gone ahead and put on a spread going all the way out to June and July. And I was talking to Jim about this over the weekend, and Jim says, why so much time? And first of all, the spread only cost me 22 cents, and I bought tons of contracts at 22, so not tons, but I bought a decent amount of contracts. And it's going to allow me to start positioning for the volatility because I'm expecting swings. For anybody who's been through market swings, we can be up and down. You know, just to use the Dow, because most people are familiar with the Dow, we're at 18,000, 17,000. I wouldn't be surprised if you see us open 1,000 points up or down in the morning, you know, with a gap, and we could close up 1,000 points at the end of the day. Or we could have gone back and forth and closed even. So
if we go back to tradable ideas, you know, one of the things I asked Jerry, I asked him why so far out. One of the things that ends up happening with calendars is that because the implied volatility can change so much, like in the front month versus, say, the 6 months out, some people might think that you end up having a long volatility trade on if you sell, let's say, you know, the 3-week option and you buy the June. You really don't, because that front week can end up just moving so much in terms of its vega. One of the things that I did like about Jerry's stuff, I asked him why so long, but his time frames weren't that different, right? He had like a 5-month and a 6-month option on, or I forgot if it was a 4-month and a 5-month, but it was 1 month apart, way out. It was very, very cheap. And if we do end up getting this sideways pattern, that calendar will just grow over time. My trade, because I ended up thinking the same way that Jerry did, you know, we talked about the technical analysis. My trade that I put on, okay, for this thesis in the Russell going, you know, sideways to down over the next month, you know, several months, is that I put on a March bearish butterfly that was centered at 115, or actually I put it on in the Russell is at, you know, 1,150. And I ended up making my wings relatively even. So again, I tried to end up putting this thing on when volatility had spiked a little bit, try to get it on really, really cheap. And I think they're shots, right? But they're shots where I think that we're risking 1 to make, you know, 4. And I think that we have a, you know, maybe, you know, better than at least a 1 to 4 chance, probably closer to a 50-50 chance of being able to make some money on these things. And one of the things that Jerry ended up mentioning, and I'll do the same thing, is how do you end up taking money and your profits out of these things? And again, using the technicals to be able to end up doing that becomes very, very important. So when we think about, what we're trying to do on the market analysis class is that we're just trying to go at the index level, what's going on in the market. We're not trying, this is not a class, okay, where we're teaching stuff. Jerry will be offering, okay, a technical analysis class, both a high level where he's going to go through a high level thing, and then he'll also end up doing all of the details behind everything. You'll see that come to market. We'll probably end up bringing that class within the next couple of weeks. Jerry's going to end up doing at least one full hour on technicals and some of the overview of things that he ends up looking at. So that will end up being, very, very high level, okay, educational webinar that we'll end up doing on technical analysis. Going forward, more and more the things that Jerry and I have spoken about in terms of looking at the technicals to put on the best options trades. We're going to be working together more to be able to end up starting to bring you some of these types of thoughts and ideas. We want to end up sparking, a conversation, okay, in the community, and we'd like to end up inviting people who end up looking at this stuff, and we'll have you on, and we'll end up talking through what do you end up seeing, why do you end up believing one trade might be better than another. We could end up doing our compare and our contrast of here's the way the butterfly worked versus the calendar. As long as, you and Himanshu don't team up on me, I'd be glad to have that conversation, okay? For those that you don't know, Himanshu Raval is, he's the calendar king, okay? He does calendars for just about everything, but he's also ends up understanding how the Vega ends up working, and he plays that to his advantage. I know a lot of our community prefers the verticals, the butterflies, the condors, because you don't have to deal with the multi-month different volatility. You only have to deal with skew in one direction. Anyway, so that's what we've been trying to end up accomplishing. I hope that this has been informative of where the market currently is, what we're looking at, and we're going to end up continuing to end up doing this on a weekly basis to be able to end up just kind of doing a review of the market and, how we're trading it in general. Your opinions, okay, and if there's different things you want to end up seeing on market analysis, please write to Tom and I, anybody who'd like to end up coming on and talking about, indicators that they look at. This is a community, okay? This isn't just a one-way thing. Jerry's been very generous with his time, and we appreciate it. And we really look forward to being able, Jerry, to end up seeing, the technical analysis free webinar that you're going to end up giving, and then the paid class, okay, the details for that. And I'm sure there'll be a lot of people in the community, because if there's one thing, okay, that ends up working across all types of trades, whether you're a market neutral trader, whether you're a directional trader, whether you're trying to sell covered calls like we're doing in our class, understanding where your current stock or ETF or index is, understanding where your supports and your resistance are, and what chart patterns and what technical analysis studies that you could be or should be looking at to be able to help you get a little bit better edge on things can make the difference between winning trades and losing trades. And so what we're going to end up doing is we're going to try to end up bringing in more and more technical analysis into our options trading approach. We've always been an options community. That's what we're going to continue to be. But I think that not looking at the technicals through the eyes of an expert, we're giving up a lot of edge that we shouldn't be, and that we think that it's going to end up making, all of us much better traders if we can end up just looking a little bit better, having a little bit more in-depth look at the technicals. I can't tell you how many times it's almost this running joke, Jerry, and you're not part of one of our trading groups, but in the options trading group, right, we don't have any technical analysis trading groups. Maybe you might want to think about that, hint, hint. But in our options trading groups, we almost kind of make jokes about, okay, as soon as somebody puts on some type of a roll trade or some way to be able to do an adjustment so that they can get their deltas back in line. It seems that every time we end up putting one of these things on as individual options traders, it's almost like the market knew we hit that bottom, we hit that support level, and we bounced right back up, and we wasted money on the adjustment. Well, by taking a look at a at the technical analysis, what I've seen work extremely well is that, we're coming down to an adjustment point, and even though the adjustment point's another 8 points away, there's no other resistance between now and the adjustment point, so maybe I put on a third of the adjustment early, maybe half of the whatever it is. So then when we get down to the adjustment point, we don't need to do anything because we've already made, enough of our adjustment that we've curtailed and softened some of the loss. So now we can end up letting it get to that support level and bounce back off. That's the type of trading that if you have a strong handle on the technical analysis, you can end up accomplishing. And in Jerry's technical analysis class that he's going to end up going through, we're going to end up giving you a lot of examples of how to end up, trading those option types trades. And Jerry and I will end up working together to kind of end up bringing some of those nuances to the options trading world. The technical world by itself, Jerry's the one who's going to end up teaching. But how to end up bringing the two is kind of in between where we feel that it could really help people's trading. It can end up giving you that extra edge where, you were an okay trader, you're bringing in some money, but you just couldn't end up getting those yields as high as you wanted to, or you couldn't end up protecting against some of those losses. How many times have I seen where there were some traders where they ended up having, great month, and then all of a sudden they have a horrible month where they weren't able to end up keeping the profits that they made for the last 3 or 4 or 6 months. By doing the technical analysis, it's going to end up giving you the confidence to be able to say, you know what, I do need to end up getting out of the trade here. I do need to end up making this adjustment at this point. And that's going to end up being the difference for some of you. That's going to be the difference from being, a flat to average trader to becoming a really, really good options trader. And that's what we look forward to end up helping folks with going into the future. Jerry, anything you want to end up adding?
Jim,
Yeah, a little.
Dave Stewart said that he'd like to show us something real quick, if you don't mind.
I tell you what, if you would pass Dave the ball, okay, Dave, we'd love to end up seeing it. Dave, you start to end up and promote Dave to a panelist. And Jerry, if you would just end up answering the question while Dave gets all set up.
Yeah.
Anything you'd like to add?
Yes, I do. I'm looking on another screen, some comments. There was Bob A. who left early. There's some comments I just want to address. Somebody was saying nothing's being said. What are we learning here? When it comes to charting and technicals, understanding the difference between a wedge and a triangle, taking a look at the differences between candlestick patterns. I showed a trade that I'm in. And it's interesting, Bob left. I wish he was still here. He said, watch your deltas. Well, no, I don't know. This is a delta neutral trade. In fact, he said, watch your delta. It's all Vega.
Okay. Listen, I don't want to get off track. Okay, the thing is that we weren't trying to teach anything here. Okay, what we're doing is we go, right. and some other members already said this. This is a review. We're looking at the market. Okay, and that's what we're doing. If you want to end up going through a class, they're going to be offered. That's not this. So is there anything, though, going forward? Okay, it's a forward question. Anything you want to end up adding to what we're going to be presenting and what you're going to be showing in your technical analysis class that I didn't already mention?
Yeah, I'll be going over, all the stuff I use as far as candlesticks, moving average strategies. I've got indicators that I watch for momentum, for entries and exits. How to determine price and time targets is the whole idea. Okay, looking at the right edge into the future is if I can go ahead and project where I believe with high probability where price is likely to go to within a certain amount of time, that gives me my edge when I decide to go ahead and put on a trade based on my assumptions.
Right, exactly. And what Jerry and I have talked about is that then what we'll end up doing is that I'll end up, helping Jerry where we'll take a look at what's going to give us the best risk-reward ratio based on the technical assumptions. So we're going to end up marrying, the best options skill and the best options skew and looking at volatility in a time frame so that we can end up getting the best risk-reward ratios based on a set of technicals, okay, that Jerry's going to end up going for. So I'm really looking forward to this. I think this is going to be absolutely great. Dave, welcome.
Welcome. Yeah, I was just going to do this real quick. You can just call me Colonel Klink. I know nothing. I don't believe in technical analysis, but I do use it, so that's sort of weird in that sense. But what I use is just the price. Now, I happen to have this garbage here in here because I like
you look a lot like Himanshu's screen.
Yeah, well, I started looking at it again when he brought it up, but it's all garbage anyway. You really don't, I only look at this. This ADX can be useful, but to me it's all nonsense. But I was just going to show you had fundamental news on Qualcomm that came out with their China suit while you guys were talking, and this is the kind of stuff that I look for. And then so I go in, buy the stock at 69.0, I mean at 68.70, right?
Okay.
Now, when I look at the chart, I look at this gap fill here.
Yep.
And I do this all the time. I did it on Twitter. I had an earnings diagonal on, sort of like what you and I discussed, the thing that didn't get recorded.
Yes, sorry about that. That was a great conversation. I messed that up. I apologize.
No.
For you guys that missed it, it was a great presentation by Dave.
I already talked to Tom, so we'll just sort of redo it in the next few weeks. But I did a similar thing on Twitter, and I made basically very little on the trade, but a little bit on the earnings trade. So then the next day I turned around, I bought back the short ones. I ended up keeping one of my long calls and putting it into a vertical. So the vertical cost me less than retail. And all I'm looking for is that was the gap fill. Oh, excuse me, on the stock. Forget the options.
Right.
I'm misspeaking. I had 100 shares of stock, sort of like what we did before. And I looked for Twitter to go to, I think it was 47.18 was the gap fill. Let me look. Yeah, right
you
here.
got a couple of gaps there.
Well, look at this one here. The low is 47.18, right?
Yeah.
So 100 shares was gone at 47.18 the next day. And then I kept a long vertical that cost me almost free, a 47.48, where if I lose 400. If it closes at 48 or higher in the March options, I'll make about 1,600. Now, so with this Qualcomm, I'm just looking at this gap right here, nothing fancy. What's it about, 70.94? And if the big boys want to push this up to that price level, fine with me. Otherwise, I'll use some options to protect this tomorrow, or I'll lose money. But I did. My point is, I look at gap fills because they tend to get filled more often than not. And that Jeffrey would probably agree with me on that. There's a lot of technical work with gaps, and you can look at those in the indexes too.
Yes.
They seem to be the big machines and the big players sort of target these things. I don't know how they do it, but they seem to be able to do it. Of course, I like this gap up here, Phil.
That would be very nice. Okay.
So that was all.
And that's a huge gap. But by the way, you know, today I was going over some technical, some of the things that I looked at in terms of charts and technicals, and I wrapped it all together because, you know, when I take a look at technicals, you know, I think about chart patterns. You could end up saying Fibonacci's or candlesticks are part of chart patterns, and then the rest of it, you know, I kind of take a look at. You could look at oscillators in terms of technical analysis or momentum indicators in terms of technical analysis. But in the chart patterns, one of the things that Jim Bittman, okay, from the CBOE, he had recommended a book years ago called 7 Chart Patterns That Consistently Make Money by Ed Dowd. And, you know, one of them he talked a lot about, right? He talked about gaps. And, you know, you talk about breakaway gaps, filling the gap, exhaustion gaps. And I, like you, believe that, you know, almost all gaps get filled. Playing for the gap fills are just, I think great high probability trades. And the way that I like it, and, when you ended up doing the presentation, the thing that's really, really nice is that you play for gap fills, but you have an asymmetrical bet. Meaning that the way you end up structuring these things is that you'll end up like risking one, okay, if things, protecting with the options the way you end up showing, but if it works out, you'll make four.
Right.
And they do tend to fill. So I think it's a very, very strong way. And the next time we get a chance to end up doing this together, I will record it so everybody can listen.
Yeah, no,
We
we'll
did that.
we'll redo the whole discussion on Gilead, and then I'll show something like in Twitter that was similar. Now, like
That
in
would
this
be
case,
great.
all I did was buy stock because it was after hours, just so you know. So there's a lot of risk in this.
Yes, and we did talk about that. But, one of the things, and when we end up doing this, we did this on Trading Group 1, okay, that we're going to be making earlier because it was too late for a lot of people on Wednesdays. One of the things that we ended up talking about was that many, many times you end up having these excessive moves in an underlying as soon as earnings come out. But when you know a stock extremely well and you've been following them the way that we talked about, Dave, that you followed Gilead. You know that, hey, at this price, this is very, very reasonable. I think that we can end up moving down to this level, especially if you understand, and here's the most important thing, which Dave was very, very clear that he understood. Understanding how fundamental news will end up affecting price and understand the level to which that fundamental news will end up moving, okay, at prices. Because things move in the after hours, especially after earnings or other event type moves in the market, being able to end up having that confidence because you've been trading this thing so long is absolutely critical. And being able to do that with after-hour stock, while much riskier, like Dave just said, then being able to end up trading the options around it, you can end up, okay, developing the skills to be able to end up having trades that have better than 50-50 odds, okay, with having just asymmetrical payouts in your favor.
Yeah, and then just to close, like the shadow trader sometimes talks about half back, so we're about half back here. But I was just going to say, if I wanted to, I could just close this for lunch money, but I feel that you can't make money in this business just taking small gains. You've got to be willing to put some risk on. So I'm okay with staying with this based on that daily chart, and based upon the fact that the market didn't drop too much today. We might have an up market tomorrow. Apple's moving up. Qualcomm's related to that. So I'm willing to stay with it for a little while.
Right. Yeah, the one thing I just want to make sure, because people may sometimes listen to a little bit of one webinar, a little bit of the other, and saying, hey, I just got more confused. One of the things I just wanted to end up commenting, we have in other trading groups talked about taking profits off the table. But what we were talking about there, when we were talking about taking, when you end up reaching 25 or 50% in some areas, when we talk about taking a smaller percentage, usually those things are butterflies, where you never have a chance of being able to collect all of the money because it's a peak. So taking out some percentage. You heard in Quanti Carlo, Larry Richards talk about they statistically found that when you're doing the wider iron condors, instead of trying to collect 100% with these high probability, extremely wide between the shorts, iron condors, maybe only take 80 to 90% of your profits. That's very, very different. They're playing the theta game, okay? What Dave's talking here is not playing the theta game. He's playing the directional game. So if you're going to end up playing the directional game, you do want to have asymmetrical bets, risk one to make four. Those are the ones where letting your profits run make more sense. So don't confuse the high theta trades to the more directional and chart pattern types of trades that Dave's talking about, right? They're very different. So you're going to have to end up realizing as a trader what's best for you. You know, where's your skill set? What do you end up working best with? Because you'll find that different people have different personalities, and you need to end up trading with a style that you're most comfortable with. If you ever try to end up trading with a style you're not comfortable with, you'll struggle your entire trading life, I believe.
Well, yeah, just one last comment, and I don't know anything about it, but I've been looking lately at these advanced decline numbers, trying to look at them more. So I don't have anything to say about it other than I'm trying to pay more attention to it. And of course, that Mark Cook, the famous trader, keeps track of this, and he has some summation that he uses, and he claims, you know, that he's made millions and millions of dollars. But I don't have anything to say other than I have been looking at these lately.
Okay.
And, you know,
well, you know what?
It wasn't
We'll
too bad. We didn't have too bad of a red bar today.
All right. We'll talk about that because two comments. The first one was if you ever have read IBD and William O'Neill stuff, they talk about accumulation versus distribution. Okay, and so I look at volume and then I look at breadth. Okay, two separate things. First, on the volume, in the William O'Neill can slim approach, you want to end up seeing up days on higher volume. You want to see breakouts on the chart on huge volume. That shows institutional interest and institutional accumulation versus a distribution day is if you have a big sell-off on volume. Okay, that's usually when institutions are getting out of a position and you'll end up seeing, you know, more selling to come. So taking a look at the volume, okay, being able to confirm moves is very, very important. What you're talking about here sometimes is called breadth. The breadth of the market. I had mentioned this actually today in the covered call class that we're doing, where, you know, I could have saved myself, had I learned this a couple of years earlier, I could have saved myself an awful lot of money during the dot-com boom. Once we got over the 2000, January of 2000, what we ended up starting to see was that the market actually made a high in March. But if you take a look at the participation, the breadth of the market, how many stocks were advancing versus declining, the advanced decline line was going down as the market had made new highs. That's never a good sign because if less and less stocks are contributing and participating in the market run-up, those few leaders, okay, as soon as they stumble, the market can end up selling off and selling off very, very hard. So breadth, volume are other components to, you know, a technical analysis approach. And so those will be very, very important things to end up looking. And when we take a look at this, we do want to have, and anybody who has stuff who would like to end up presenting, who's watched these things, you know, in detail, you know, send Tom and I an email. Love to have you either on the market analysis or maybe on a roundtable or on a separate WebEx to be able to end up going through what the whole concept of the community is for us to end up sharing our different areas and being able to become stronger traders individually by the use of, you know, helping one another.
And then just lastly, I'm sorry to take all the time. During the day, a lot of times I'll just look at this E-mini future and then the VX future.
Yep, I look at those all the time. Now, one of the things I'll look at, for example, if you just keep it right there, I know it's the end of the day, so it really doesn't count. But take a look, and you'll always see the volume bars be very, very high on the E-minis in the last few minutes of trading before 4 o'clock. It's people either getting out of positions or setting their overnight hedge, so you'll end up seeing the volume. But one of the things that was very concerning, okay, on this chart is if you take a look at the highs that we ended up making around 1545, we ran up, right? We ran up, but the volume didn't get any higher.
No.
So there wasn't, when you see that run up, you want to end up seeing heavy volume, because that's telling you that there are real buyers in the market versus, just market manipulation going back and forth. And by watching that commitment, okay, of volume in the E-minis, because it is so heavily traded, is a pretty good, okay, indicator. I've been able to actually see, the stock market say in the morning, we're making new lows, we're making new lows, we're making new lows, but there'll be a little bit of volume that drives things down, but then the volume, dries up, and then it comes back up, okay, with a little bit higher volume. Then it sells off on lower volume. And it's the stair-step, okay, approach down in terms of price, but the volume is not confirming it, because on the down, okay, ticks, we're doing it with less volume, and with the upticks, we're doing it with more, which means that as soon as the selling pressure stops, or at least, lessens somewhat, we're going to end up having a pretty hard bounce back up. Looking at volume and looking at breadth or participation rates are absolutely key, okay, in terms of a bigger picture when taking a look at a fundamental approach.
Yep, absolutely.
And I think
and by the way,
time to stop. What do you think, Jim?
Sure.
I think so. My last comment was, gap fills are probably, in my opinion, in all the stuff that I've read and taken a look at, probably one of the more reliable, patterns that you can end up making money on.
All right, so we'll keep looking at that stuff. Great, guys. Thanks, everybody. Jeffrey,
Dave,
Tom.
we appreciate it.
Yep.
Jerry, thank you very, very much for sharing, with technicals. We look forward to it. And we're hoping that you got some actionable trading ideas that you can end up going back and taking a look at your own trades. And when you do, please let us know and come on and share with us. That would be absolutely great. Thank you, everyone.
Thanks, everyone. Bye.